They decide interest rates. They control government spending. By the end of this video, you'll know more than 90% of investors out there. So, what's a bond? Simple. A bond is an IOU. You lend money to a government, a company, or even a city. In return, they make you a deal. They'll pay you interest, which is called the coupon. And they'll give you back your original money on a certain date called maturity. That's it. You're not owning part of a business like a stock. You're basically the bank. You give the loan. They pay you back. Key parts. First, the issuer. That's who's borrowing the money. It could be the U.S. government, Apple, or your local school district. Second, the principal. That's how much you lent them, usually in $1,000 chunks. Third, the coupon rate. That's the interest you get. Treasuries are considered the safest in the world. Low return, but very low risk. Municipal bonds come from cities and states. The cool thing? The interest is often tax-free. Corporate bonds come from companies. These usually pay more than government bonds, but they carry more risk. And then there are junk bonds. These are from risky companies that might fail, but they offer sky-high interest to attract investors. Each type plays a role, and smart investors use a mix to balance safety and growth. Here's the part most people don't realize. Bonds actually control the economy. The government issues bonds to fund wars, build highways, and pay for programs. The interest rates on bonds influence how expensive your mortgage or car loan will be. Even the savings account. So, when you hear that the Federal Reserve is raising or lowering interest rates, what they're really doing is adjusting the bond market. Bonds are the engine behind the money system. Of course, bonds aren't perfect. They come with risks. If new bonds come out with higher interest, your old bond loses value. That's interest rate risk. Inflation can eat away at the money you earned from bonds. That's inflation risk. Companies can go bankrupt and fail to pay. That's default risk. And sometimes bonds are tough to sell quickly. That's liquidity risk. But compared to stocks, bonds are usually steadier and more predictable. Here's the easiest way to think about it. Stocks are about growth and ownership. If the company does well, you share the profit. Bonds are about stability and lending. You get paid first, but you don't share in the upside. That's why serious investors use bonds to balance their portfolios. It's like sports. Stocks are offense. Bonds are defense. And you need both if you want to win long term. So, if you don't understand bonds, you don't understand money. Next time you hear about interest rates, government debt, or inflation, you'll know bonds are at the center of it all. If this breakdown helped you, hit that like button, subscribe to Young Capitalist, and stick around.